Hey everyone, let's jump right into this explainer. If you've been watching the real estate market over the last couple of years, you know exactly what it's felt like. It's been completely stuck in ice. But the data we're unpacking today points to a major thaw. We're transitioning from this frozen status quo into a highly dynamic, opportunity-rich 2026 landscape. So today we're going to explore exactly how this market recovery timeline is going to unfold step by step. And I'm going to give you the exact playbook for how to navigate it. Now, take a look at this number right here. 6.25%. I want you to remember this because it's not just another mortgage rate. According to industry models and behavioral economics, it is literally the psychological tipping point for the entire 2026 housing market. Historically, it represents roughly the 50-year average for rates. Basically, anything above it feels like a massive financial penalty to consumers, but anything below it, well, that starts to feel normal again. So you might be wondering, can this one specific percentage really act as a psychological catalyst to end all the gridlock we've seen? You see, ever since we hit those peak rates of 8% back in 2023, the market has essentially been paralyzed. Buyers have been totally priced out, and sellers have absolutely refused to give up their low pandemic-era rates. But 6.25%, that is the exact threshold where the math fundamentally changes for both sides of the transaction. I absolutely love this quote where the American housing market finds its pulse again, because it brilliantly illustrates the exact shift we're about to see. We are moving away from the paralysis of 2023's peak rates right into the great unlock of 2026. It's that pivotal moment where consumer sentiment flips from just sitting on the sidelines to actually taking action. But to really understand how we get there, we first need to understand the freeze itself. Which brings us to Section 1. The freeze, and breaking the lock-in effect. To understand how we get to this big unlock, we have to talk about why millions of homeowners have been completely stuck. It's known as the lock-in effect. Think about it. Millions of folks secured mortgages at 3% or 4% between 2020 and 2022. If they tried to sell at 7%, their monthly payments would nearly double for the exact same house, so they just stayed put. Drawing directly from a Bank of England study, this data perfectly explains that drag. It shows how behavioral loss aversion keeps sellers from listing when they face a massive rate penalty. Basically, sellers optimize their strategies based on potential gains. When rates are super high, the penalty is just too punishing. But as rates drop closer to that 6.25% mark, the penalty starts to feel like an acceptable cost of doing business. Suddenly, major life events, like a new job or a growing family, start winning out against that rate lock. Let's put some real dollars behind this. A rate drop from 7.5% down to 6.25% saves a buyer roughly $333 a month on a $400,000 loan. That is huge. It translates all this dense economic theory into the exact human psychology that turns a painful monthly payment into an acceptable one. And it's exactly why housing market surveys are showing that hitting this mental threshold is going to bring about 20% of sidelined buyers rushing right back into the market. Moving right along to Section 2, unlocking the 6.25% threshold. Now, mortgage rates don't just magically drop out of thin air, right? They're driven by broader macroeconomic forces. So here is your step-by-step guide for monitoring daily rate changes to lock in those savings. Step 1, keep an eye on daily inflation reports. When inflation cools down, rates usually follow suit. Step 2, track the 10-year Treasury yields because mortgage rates closely mirror these bonds. As investors move their money to safer assets, Treasury yields dip, and that influences daily mortgage rates downward. Step 3, watch for media headlines to shift from crisis mode to recovery after rates stay low for a few weeks. And then step 4 is when the real magic happens. This signals the inventory release valve opening up. When 6.25% holds steady for 60 days, the models predict a massive 15 to 20% jump in new listings as all those locked-in sellers finally put their homes on the market. All right, Section 3, California's 2026 Regional Outlook. Let's zoom in on the specific 2026 landscape for California. The state is massive, so we're really moving away from a one-size-fits-all market. Looking at this hard data from the California Association of Realtors, they're projecting a gentle climb. By the end of 2026, affordability actually inches up to 18%, and sales jump by 2% to over 274,000 units. The median price expected to rise by 3.6% to around $905,000. It's signaling a steady, reliable market recovery. And remember, we are contrasting that massive inventory release valve we just talked about against current economic stability factors, things like slowing GDP but steady employment, which is exactly what prevents prices from crashing. This brilliantly illustrates the incredible contrast between regions right now. On one side, you have the San Francisco Bay Area. It's got a stable but pretty stagnant median price of $1.4 million, which is obviously a massive barrier to entry. On the flip side, you have the Central Valley in the far north. These are your emerging, high ROI, affordable growth hotspots inland. They're boasting the strongest year-over-year sales gains, precisely because their starting price points are just so much lower. So for investors out there trying to identify these emerging affordable growth areas within California, you have to weigh a few key indicators. You really need to compare how local job markets and supply levels create these unique investment hotspots. You're looking for local job market expansion, a rising localized housing supply, and underlying economic stability, like California's projected stable 5.8% unemployment rate. When you combine those factors, you get prime capital deployment opportunities far away from those expensive coastal markets. Let's pivot to Section 4, Navigating the Mortgage Market. Look, this higher-for-longer rate environment means that waiting for rates to plunge back down to 3% is a losing game. You need an actionable playbook right now. Here's your buyer checklist. Strategic urgency is absolutely critical here. First, calculate your specific acceptable monthly payment right now. Next, gather your financials immediately. And finally, get pre-approved before rates officially cross that 6.25% line. Why? Because waiting for the absolute bottom is dangerous. Remember, 20% of sideline buyers are going to rush in all at once when that psychological threshold is crossed. You want to be pre-approved and ready long before bidding wars become the norm again. So the crucial point for first-time buyers looking to improve affordability is this. You must compare multiple lenders to secure the best rate spread. Even a tiny fraction of a percent dictates what you actually qualify for. Next, look heavily into new construction. Builders right now are offering major developer incentives, specifically mortgage rate buydowns. These buydowns can significantly lower your monthly payment obligations, literally dropping your effective rate down into the 5s or even the high 4s. That is something you will almost never find available on the standard resale market. Next up, Section 5, the 2-week rate strategy. Now, what if you are a locked-in seller, waiting for the perfect moment to move up or downsize? How do you perfectly time your listing with the incoming wave of buyer demand? Here are the essential steps to evaluate the 2-week rate hold strategy. Step 1, watch for rates to hit 6.25%. Step 2, hold your horses and monitor the market for 14 consecutive days. When rates stay low for 2 weeks, media sentiment shifts and buyers are primed. Step 3, list your property exactly as this media sentiment shifts to recovery. And Step 4, adopt realistic pricing. Avoid aggressively fishing with inflated prices because the data shows this drastically reduces your probability of a sale in a market that's about to be flooded with new inventory. Okay, Section 6, the refinance conversation. But what if you aren't looking to sell at all? What if you just want to lower your current overhead? Let's analyze when current homeowners should actually refinance. See this number here, $330. That represents the average monthly savings on a $400,000 loan generated by just a half-point rate drop, say dropping from 7.5% down to 7.0%. For a lot of households, an extra $330 a month is a highly meaningful reduction in their daily cost of living. Which brings us to the big question. Should you evaluate a refinance and lock in that half-point spread right now to guarantee immediate savings? Or do you hold out hope for hitting that 6.25% threshold later in 2026? Homeowners really have to analyze their own timeline and daily rate changes to decide. If you're planning to stay in the home long-term, taking the sure thing half-point drop right now might actually be a whole lot safer than trying to perfectly time the absolute bottom of the market. Finally, Section 7. The investor deployment window. Let's define exactly how capital deployment timelines shift during this specific real estate window. For investors aiming for optimal capital deployment in these emerging California markets, you have a very specific 18-month opportunity. Here's how it unfolds. In month 1, the 6.25% threshold is crossed, and you start deploying capital into affordable growth markets like the Central Valley. By month 6, market velocity peaks, meaning the spring market is roaring and listings are flying off the shelves. But by month 18, the window effectively closes. That massive 20% surge in buyer demand will have chewed through the new inventory, recalibrating prices upward and compressing your ROI. You absolutely have to move quickly. The big freeze is finally ending, the lock-in effect is breaking, and that magical psychological tipping point of 6.25% is coming right into view. The only question left is how you choose to navigate the thaw. Will you be caught waiting on the sidelines, or are you ready to deploy your playbook before the market completely shifts? Well, that is all we have for this explainer. Thanks so much for joining me as we broke down all this data, and I'll catch you on the next one.